This week we had inflation figures for March and they showed a continuing pattern which we've had this year of inflation being a little bit higher than it was last year. Last year, for the second half of the year, the inflation was running pretty much at the Fed's target, and it was felt that just a few more months of that would be enough to make them feel like they had basically brought inflation back to where it needed to be and they could start to lower interest rates. But the figures yesterday haven't really continued that trend and inflation's crept back up a bit. The RBA will take a look at what's going on over in the United States. Their decisions will really be governed by what's going on here more than anything else. And here, I think the situation is quite different. The big distinction is that our economy is much more subdued. It's only growing at about 1%, which is below the trend rate, whereas in the United States, they look like they're growing at more like 3% or so. I still think there is a chance here that rates will be lowered at some point. It'll just depend on seeing a continuation of the current conditions. Well, our recommendation across asset classes is to still be overweight fixed income, which generally benefits from falling interest rates. In equities, we're recommending now a more benchmark position because falling interest rates should help in time restore the economy's growth and the corporate earnings growth, and that should be good for the stock market. What we're suggesting to clients is that they have less in defensive cash positions than normal and to be positioned in markets for a potentially better than average period. If anyone would like further advice, please get in touch with Canaccord Genuity and speak to an advisor.